As a financial advisor, one of the most common questions I hear is this: should I buy whole life insurance or an indexed universal life policy? It's a fair question. Both offer lifelong protection. Both build cash value. Both can play a role in retirement, legacy planning, and wealth transfer. But here's the truth most people don't hear. Neither product is inherently better. The best choice depends on your goals, your risk tolerance, and how you plan to use the policy. Today, I'll explain the key differences between whole life and indexed universal life in plain English, so you can make a more informed decision. Before comparing products, let's discuss purpose. Too many people start by asking which policy is better. The better question is, what are you trying to accomplish? Are you looking for lifetime protection, a tax-efficient asset, or retirement income? Or perhaps estate planning, business succession planning, or wealth transfer to future generations? Your objectives should determine the strategy, not the other way around. Whole life insurance is designed around guarantees. You pay a fixed premium. The insurance company guarantees a death benefit. The policy accumulates guaranteed cash value. And depending on the carrier, you may receive dividends. Think of whole life like a dependable pickup truck. It may not be the fastest vehicle on the road, but it's designed to get the job done consistently for decades. Index Universal Life takes a different approach. An IUL allows cash value growth to build to a market index such as the S&P 500. Your money is not directly invested in the market. Instead, the insurance company credits interest based on index performance. Think of an IUL like an SUV. It offers more flexibility and potentially greater performance, but it also requires more attention and maintenance. The greatest strength of whole life is certainty. When markets crash, whole life doesn't care. When interest rates fluctuate, whole life doesn't care. The guarantees remain intact. For people who prioritize stability and predictability, that can be incredibly valuable. The greatest strength of an IUL is growth potential. When designed properly and funded appropriately, an IUL may generate higher cash value accumulation than whole life. At the same time, the policy typically includes downside protection through a floor. So you may participate in market gains without experiencing direct market losses. Here's where things get important. Both products can work well, but both can also disappoint when they're poorly designed. A poorly funded whole life policy may underperform expectations. A poorly funded IUL can become stressed, lose efficiency, or even lapse. The policy design matters just as much as the policy type. This is why illustrations should never be the only factor driving your decision. Whole life may be ideal if you value guarantees, want simplicity, or dislike uncertainty. Or if you focus on legacy planning and prefer predictable, long-term results. IUL may be ideal if you want growth potential and need funding flexibility. Or if you have a long time horizon, understand policy reviews, and are comfortable with variable outcomes. After years in financial services, I've learned something important. Financial success is rarely about finding the perfect product. It's about matching the right strategy to the right person. For some families, whole life will be the better solution. For others, indexed universal life may provide advantages that align better with their goals. The key isn't choosing the product with the most impressive sales presentation. The key is understanding how the strategy fits into your overall financial plan. If you're evaluating whole life versus indexed universal life, focus on education before implementation. The more you understand, the better your decisions become. Subscribe to Winning Hearts Financial for more videos on wealth management and retirement planning, because protecting your future starts with understanding your options today.